Hello everyone again. In this video we are going to know how to calculate the cash conversion cycle, or we can also call it as CCC. To calculate the cash conversion cycle, we should know three things: average inventory conversion period, average receivable collection period, and average payment period. So how we can calculate each one of these? First, average inventory conversion period. It will be equal the average inventory divided cost of goods sold multiply 365 days, which is the number of the days in 1 year. Second thing, average receivable collection period. We can calculate it by divided the average receivable divided net sales multiply 365 days. Last things, average payment period. We can calculate it by divided the average payables on the net prices multiply 365 days. To make it more simple to you, we can calculate the cash conversion cycle based on these three formulas. Number one, average receivable collection period, which is equal average receivable divided net sales multiply 365. Number two, the average inventory conversion period, which equal average inventory divided cost of goods sold multiply 365. The last thing is average payment period, which equal average payables divided net prices multiply 365. Now, cash conversion cycle will be equal average receivable, which the first one, added average inventory, which the second one, minus average payment period, which is the third one, average payment period. So to make it more simple to you, I prepared this simple example. The following information is extracted from financial statement of a Starline LLC Musact. So average accounts payable will be equal 50,000. Average accounts receivable will be equal 30,000. Average inventory will be equal 2,750. Net sales will be equal 75,000, and net prices will be equal 75,000, and cost of goods sold will be equal 250,000. So the required is to compute the number of the days in cash conversion cycle for each year. So first of all, we should calculate the average receivable collection period. So as the formula, average receivable collection period will be equal average receivable divided net sales multiply 365. So average account receivable will be equal 30,000. So I put here 30,000 divided, as the formula is divided net sales. So where is the net sales? Net sales, it's equal 75,000. So 30,000 divided 75,000 multiply 365 will be equal 146 days. Number two, we should calculate the average inventory conversion period, which will be equal as the formula average inventory divided cost of goods sold multiply 365. So the average inventory will be equal 2,750 divided cost of goods sold will be equal 250,000. So 2,750 divided 250,000 multiply 365 will be equal 150 days. Last things we should calculate it is the average payment period will be equal average payable divided net prices multiply 365. So as the formula, the average account payable will be equal 50,000. So I put here 50,000 divided net prices will be equal 75,000. So 50,000 divided 75,000 will multiply 365 will be equal 73 days. Now the cash conversion cycle will be equal average receivable collection period added or plus average inventory processing period minus average payment period. So average receivable collection period it will be equal 146. So 146 days now plus average inventory processing period as the formula we collected to be 150 days. So my plus 150 days now minus average payment period. So average payment period will be equal 73 days. So minus 73 days will be equal 223 days. So the cash conversion cycle will be equal to 223 days.